So if your abode has indeed been established in a foreign country, we're looking at the physical presence test or the bona fide residence test. Remember, the physical presence test requires that you be physically present in a foreign country or countries for 330 days on a continuous 12-month period. The 330 days don't have to be continuous. You can travel in between. The 12-month period does have to be, and you can use overlapping periods as previously explained. Your other option is meeting the bona fide residence test, which is very similar to meeting the definition of abode. Again, if home sweet home is a foreign country, you're probably qualifying for the bona fide residence test. If you look at the IRS guidelines, the definition is very vague. The only specific item you're going to need to meet is having been in this country for an entire tax year. That means January 1st to December 31st. If you arrive at the foreign country on January 1st, you're not going to meet the bona fide residence test for that year, but you can certainly use the physical presence test. While you will not find a black and white checklist from the IRS that will help you determine your eligibility, at Tax Planner CPA we have evaluated past cases as well as obviously Code Section 911 to come up with our interpretation of what could be the closest thing to a checklist. On our website you will find an online eligibility test that will tell you right away whether you qualify or not for the foreign earned income exclusion. One of her blog subscribers asked a very important question. If I am self-employed, am I required to pay into Social Security, and will forming a foreign corporation allow me to reduce or even eliminate my self-employment taxes? The first part of the question is a very simple yes. The foreign earned income exclusion applies to federal taxes, but if you're self-employed, you will have to pay 15.3% towards Social Security and Medicare on your net income, that is on your Schedule C. The second part of the question is a little more complicated. You do not want to start a foreign corporation solely for the purpose of evading U.S. taxes. This is a criminal offense and you do not want to do that. However, if the question you asked is different and what you're asking is if you're an employee of a foreign corporation, will you be subject to Social Security taxes? The answer is no. If you're employed by a foreign corporation, you do not have to pay taxes on the first $91,500 for 2010. Neither federal taxes nor self-employment taxes, Social Security or Medicare. If you're employed by a U.S. corporation abroad, you will still be subject to Social Security and Medicare taxes, but your portion is only 6.75%. Now, whether that corporation is owned by you, it does not matter. It's still a foreign corporation and you do not have to pay Social Security and Medicare taxes. This is different for American citizens living abroad employed by U.S. corporations. They do still need to contribute their portion into Social Security and Medicare of 7.65%. But if it's a foreign corporation, 100%, no, you do not have to contribute into the system. That doesn't mean you can't start a foreign corporation. What I'm saying is you need to be careful to have the right reasons to incorporate, because if the IRS comes and makes an argument that you did it solely for the purpose of avoiding U.S. taxes, explicitly self-employment taxes, that is a criminal offense. His follow-up question is, if he does form a foreign corporation, what are the tax and reporting implications? The net profit of the corporation will not be subject to U.S. taxes until it's distributed to the U.S. citizen in the form of dividends. You do have to comply with certain reporting requirements. Form 5471, informational return on a controlled foreign corporation. Basically, the U.S. wants to know the financial statements for this corporation, who the owners are, and you have to do that on an annual basis. Another common question on our blog relates to the foreign bank account reporting, Form TDF 9221. Very simple. The United States wants to know about any bank accounts you had in a foreign country that had a balance of $10,000 or more at any point during the year. It's not just bank accounts though, it's any financial account, mutual funds for example, and it doesn't have to be that you own the bank account. Whether you have signatory or any type of control over the bank account creates this filing requirement for you. So if you own a foreign corporation, you hire a treasurer and you don't have signature on that bank account, you still have control over it, you still have to report it. Another common misconception is that it's the average balance or the ending balance. That is not the case. If at any point during the year the bank account had a balance of $10,000 or more, you need to file Form TDF 9221. That means if you receive a wire transfer on a Monday for $20,000 and it wires out on a Tuesday, you already have a reporting requirement. The penalties for not filing Form TDF 9221 can be very harsh. If the IRS can claim that you had criminal intent, the penalty can be up to 50% of the balance in the bank account. That means it's going to get wiped out in 2 years. However, if you have otherwise reported all your taxable income and complied with your tax return requirements, you will not have to worry about these penalties. You simply there's a procedure for filing these late ad bars.